Every year when we come with our prospects to the market, there's always a bit of hope, and there's certainly also a bit of trepidation. However, now we're 9 months or 10 months into the year, and I think it is true to say that if you look at the performance of different financial markets, that they've been rather disappointing. If you look at the South African equity market, the market is down by about 12%. Even worse was the listed property market that has lost about 27% of its value. And even long bond yields came down from, or went up from levels of about 8.7% to 9.2%, which means that even long bonds generated a capital loss over this particular period. It was no different for international markets, perhaps with the exception of the US equity market that gained about 3% in dollar terms year to date. But if you look at Europe and other emerging markets, we're also talking about 10% declines in the value of equity prices on average, which was certainly disappointing. I think it would be the right thing to do right now to say, what were the reasons for the disappointing performance, and could we have seen that? And maybe one should start with the world. At the beginning of the year, we certainly said that the outlook for economic growth in the world still looks pretty promising, but we felt that some of the asset prices were quite elevated. And the only thing that has really happened this year globally was that the sentiment has changed in the world and the rating of the shares came under pressure. And as a result of that, equity prices came down. In terms of economic activity, there were certainly no disappointments. In terms of company profits, there were no disappointments. But the markets simply started to become quite concerned about the sustained rally that we've seen in equity prices over the last 10 years, and the sustainability of this rally came into question. In South Africa, however, the reasons for the disappointing performance were different. In our case, the economic performance generated by companies disappointed. In other words, the profits that companies generated were lower than expected. And as we've clearly flagged at the beginning of the year, we've highlighted that there was a risk that economic growth might disappoint on the downside, and that is exactly what we've seen. So it is that combination of disappointing profit growth, disappointing economic growth that forced asset prices down in South Africa. And finally, of course, it wasn't only a case of the performance, but just like global markets, sentiment came under severe pressure and equity prices got derated severely over this particular period. I think it is true to say, so what do we do now? What should we do with clients' money at this particular point in time? We certainly just need to reassess the situation. And if I may, I would like to start with the overseas environment. It is still true to say that economic activity in overseas economies, particularly in the US and of course also in Germany, and in fact in China, those economies are still growing at a decent pace. In the US, economy is growing about 3.5%, in Europe growing about 2.5%, and of course China is still growing at 6.5%. So why are the concerns then? I think the first thing is that one has got to realize that since the crisis in 2010, we've had a sustained recovery in economic activity, and this has been the longest recovery in economic activity since the 1900s. So therefore people are simply starting to become concerned because this is an abnormal occurrence. However, cycles don't die of old age. There are other things that will kill it. And I think the big concern is simply that market participants are worried about the fact that the economy might overheat. In other words, inflation might shoot up and monetary authorities will respond by pushing interest rates up, and that will kill the cycle. So I think we need to say one or two things about the strength of the cycle. It is true to say that employment in the United States is now at full employment with an unemployment rate of only 3%. However, I think people exaggerate the risks of that. Up until now, we've only seen that salary increases have grown by about 2% per annum. So what we have seen is that the stronger economy hasn't led to an inflation rate is out of control, so therefore there's no need for the monetary authorities to overreact in a response to try and curb economic activity. However, it's also true to say that monetary authorities don't have a good track record when it comes to trying and manufacture a so-called soft landing in terms of economic activity. So those are the concerns. So when the markets are responding in a very disappointing fashion, they normally do it on comments made by monetary authorities across the world, where it does appear that some of those authorities are overreacting in the policy statements that they are making. However, we are of the opinion, like in all economic cycles, that the activity will start to roll over, that we will start to see momentum starting to decline, but we are by no means saying that 2019 will deliver a global recession. And that is our base case view. Of course, like other cycles, there's always a risk that an external event might kill the economic cycle. And one of the external events that people talk about, of course, is simply the trade war that is currently starting to emerge between the US and China. Our own analysis would suggest that only 3% of global trade is the trade between US and China. And the direct impact of the trade war is likely to push inflation up, but we don't think it will derail. The direct impact won't derail the economic recovery. Of course, it also brings indirect implications with it. And our big concern in terms of indirect implications are that it does have an impact on consumer confidence, it does have an impact on business confidence, and that will, of course, spill over into negative sentiment and the economy starting to roll over. The other external event that normally caused economic cycles to die is a shock from a commodity price perspective, and particularly the oil price. In this case, we've seen the oil price going up to over $80 a barrel. However, we think the risk of the oil price derailing economic activity is low. And the reason for that is simply, in the last decade or so, we've seen significant supply coming from shale gas producers in the States, which will come in as soon as that oil price goes up. They will come in, introduce new supply into the system, and that should keep a lid on the oil price. So by and large, to summarize, momentum is starting to come off. We don't see a recession in 2019, but the market is extremely concerned about those risks. And as long as those concerns remain, the market, and I'm talking about the equity market, fixed interest markets, and the property market, will act in a very nervous fashion in terms of news flows, and that will create further volatility in the markets. If we look at the South African market, the story is certainly different. In our case, unlike previous stronger global cycles, we did not join the party. In other words, there was a disconnect between the strong growth that we've experienced globally and South Africa. And I think the reason for that was simply that we had a period of sustained mismanagement of the economy that led to the recession, which means the size of the economy shrunk in the first quarter and in the second quarter this year. And with that, of course, both the consumers in South Africa and the business sector in South Africa lost confidence, which means that they have delayed their decisions to spend their money on consumer goods or on further investments. Going forward, we expect the economy to slowly move out of the recession, but it will only be a very pedestrian growth rate that we are likely to see in 2019. Nothing to excite us. So then, what does it mean for financial markets in South Africa? As I said at the beginning of the year, we were not that concerned about the South African market from a valuation perspective. Even the decline of 12% in the capital value of shares in South Africa on average, what we have seen is that a lot of value is starting to emerge. If I just take the talk in the investment part of the company, suddenly as a team, we find far more buying opportunities simply on from a valuation perspective now compared to 12 months and 24 months ago. Although we don't reckon that the local environment is supportive for significant recovery in local equities, the downside risk should be limited given the low valuations that we currently experience. And that is perhaps also true for the property market. If you just look at the yields that some of these property counters deliver at the moment, Growth Point trading at a dividend yield of 9%, Redefine trading at a dividend yield of 10%, we can certainly see that there's a lot of negative news priced into these asset prices. That leaves us with the last asset class in South Africa, namely government bonds. And again, the negative sentiment was clearly reflected in the prices of those bonds, with those bonds trading at about 9.2% as we speak. We just believe that the values in the equity market and in the property market for us are far more compelling than the bond market, given the risk that we see there. In the final analysis, each and every client must have a particular structure to deliver a particular investment outcome over time. And the fact that we are going through a down cycle shouldn't necessarily have a major impact on that structure. However, having said that, asset prices do move, and we do think it is important that we actively take those asset price movements into consideration when we put the portfolio together. So at the moment, we would use a stronger recovery in global equity prices. We would use that as an opportunity to trim the exposure to global equities and reduce the risk to that particular asset class that is still not trading at bargain levels. However, despite the negative outlook for South Africa, the valuations of South African equities for us is compelling, as I say. And should the market continue to decline, we will use this opportunity to buy quality assets at very good prices and have a longer-term investment horizon in mind when we do that. So all in all, it is certainly a time to tweak portfolios. But when we tweak these portfolios, the actions that we do or perform will often go against the popular view of the day, because valuation will continue to dictate our actions.